Hello, hello. Welcome to the Spatial Show. I am one of your hosts, Elliot Golan. By day, I help lead the real estate practice at Allison, a global marketing and communications agency. Vlad, good to see you, my friend.
Yeah. This is Vladimir Bosanac. I am the co-founder and publisher of the commercial real estate news organization, The Registry, and also co-host of the Spatial Show here.
So today, our interview is, I would argue, with a very, very timely person on a very timely topic. So the audience will be hearing from Bayport Funding CEO Marcia Kaufman. Now, Bayport Funding is the short answer is alternative lender, but they are direct portfolio lender. So they're actually holding, the paper on their balance sheet. And it's an interesting time for alternative lenders the last few years as kind of the big banks are sort of still, I think a touch shy would be putting it politely, very shy.
Lending is a precarious profession these
Yeah.
days, I would argue.
Yeah, so the last couple of years have been very active for them as obviously folks are looking for some bridge financing, some extensions, some help to get through the time when maybe Jamie Dimon and his ilk aren't as keen to hand out paper on real estate.
Yeah,
But
I'm curious. I'm curious to see what she has to say and how their world is going on these days.
yeah. But as usual, it feels like there's never a quiet week in our industry.
Thank God.
Yeah, it gives us something to talk about. And it was actually quite a bit to talk about this week. What's been on your mind?
Yeah. I kind of wanted to follow up on one of our conversations from last week or a couple of weeks ago when we touched upon that big data center development in Utah, and that
Utah, yeah.
yeah, it got me sort of looking into this industry a little bit deeper. And there is a report that actually came out just in the last week or so. Cushman & Wakefield published their 2024 second half of 2024. Even right now we're in 2025, but this is sort of a looking at a rear view sort of report about the data center industry. There are some interesting kind of points that came out of it. The one interesting part is how big the largest data center market is in the U.S. And for our listeners who are not, up to speed, so Virginia is the largest market in the U.S. Obviously, proximity to D.C. and all the kind of government
Yep.
work there, and sort of not a big surprise. Capacity of about almost 6 gigawatts in operation. The second market, which is about 2 gigawatts, is Portland and Eastern Oregon. So we kind of knew that was sort of an emerging market. I didn't realize it was the
Yeah.
second largest market, but that was interesting. And then the most interesting one for me was actually that Columbus, Ohio, is number three at 1.8 gigawatts, so very close to where Portland and Eastern Oregon are.
Interesting.
Yeah, so this Midwestern city is playing, I would argue, an outsized role in the data center world. So that was a little bit of the overview. One clear message that came from this analysis, Elliot, and I'll have you know, and I think we touched upon this a little bit, is energy. All of these, so the top eight markets across the country, they have a certain amount of inventory under construction. All of it has been actually pre-leased.
Yep.
That's not terribly surprising. The biggest challenge to them building more is energy. And
Yeah.
in all of these markets, that was cited as sort of the one kind of criterion that everybody is dealing with. As I told you anecdotally, we hosted an industry event last week when one of our speakers basically said, in Silicon Valley, which by the way comes in as number 7 on that list in terms of size, is basically out of power.
Yeah.
One big thing for us to consider as we look at this industry going forward. Thoughts? What do you think about
So, I
this?
mean, Is that sort of the why Columbus thing, right? Because they probably are nowhere near running out of power, and just the demand. I mean, like, how does I obviously get that the demand in Silicon Valley is, I mean, strip mining is the word that comes to my brain. Like the resources are going to be tapped ad infinitum. I just don't think we'll ever be able to keep up. But is that where kind of like Eastern Oregon and Columbus, Ohio, and then Utah, kind of come into their own here because their own localized power requirements are, I mean, I don't want to say nothing,
Yes.
but fractional.
Yeah. No, that is certainly part of it. I think the state of Oregon has become kind of a center for data center development because of its cheap energy. Also, land is relatively inexpensive,
Right.
compared to some other markets. I mean, clearly trying to find some land, across Silicon Valley is very difficult. Partially because there's a lot of land trusts around Silicon Valley
Yep.
that own large swaths of land where you are not allowed to develop anything. And so this whole region is sort of, sandwiched between, essentially, a couple highways, right?
Right. Right.
And I would imagine in Ohio also, access to probably, land, and probably access to, power. You just don't have a population that is as big as maybe some of these other markets, and that's probably why. I would argue probably proximity to, universities. So, if you are
Yep.
going to employ people in the technology sector, certainly, schools that are in Ohio, and you've got Ohio State right next door there, right? Are big schools that probably, punch out a good number of, tech employees every year. So that's another part of it. And then I'm sure it has to be also proximity to the, technology, centers. So, Oregon kind of checks the box in terms of,
Yep.
both Seattle and Northern California. Utah, I would argue, does that too. Virginia, as I said, government, but there's also a
Obvious.
lot of,
Right.
tech firms there. And then you've got, Phoenix and Dallas and Chicago, and, all of those are, big markets, that either attract a lot of people, a lot of companies, and therefore, a lot of information as well. So those are kind of,
Yeah.
interesting points, right?
I think something not to be completely overlooked either is kind of the municipality friendliness. So, right after kind of the questions about the future of commercial office started to really balloon in 2020 and early into 2021, I would argue they still haven't been answered, but that's for a different conversation.
Yeah.
One of the topics was, can we convert some of these into data centers? Because you want to talk about, I mean, I know there's a ton of demand for multifamily, but multifamily has all kinds of zoning requirements and floor plates and parking, and it's a lot more complicated. With a data center, I mean, it's not super employee sensitive, very flexible in terms of design, right? But what you run into then is, if you have paid good money to live, somewhere in and around downtown Los Angeles or the core of San Francisco, do you want your neighbor to be a data center? And that's something that a lot of people aren't talking about is we talk about NIMBYs a lot in
Yeah.
multifamily and commercial development. It's probably to an extreme in data center development.
Yeah, yeah. I don't know. I would argue, quite honestly, Elliot, that maybe you do want to be the neighbor to a data center, because if there's ever a power outage, I
You're safe.
am certain exactly you're going to be probably on some node, that will be, maybe, double or, triple sort of checked, to make sure that it, sustains itself, right? Also, it's not. I mean, I don't think that data centers, pollute. They
No.
are obviously energy hogs, so you can argue that there's,
Yeah.
pollution from that, but that energy comes from probably a very different, disparate, distant place anyway, right? I'm not sure that that's going to, affect that. There is actually a proposal in downtown LA for one of the buildings to be converted into a data center. So I think we're going to see this more and more. I think especially if they can acquire the property at a relatively cheap base, and they can have access to sort of energy. I think we're going to see them probably being built closer to where we live. One more point on this topic, which is interesting. So Larry Fink, head of BlackRock, recently made a statement about this, that we're actually one of the other challenges that they've identified in the data center space, and they're obviously big players in this area. We've talked about this. Is the lack of electricians, blue collar workers that can actually put these things together, and he's calling that out, which is sort of interesting from kind of an education apprenticeship kind of perspective. This seems to be one of those occupations that I think is only going to grow in the future. He also called out a little bit, what might happen with sort of deportations, that kind of thing.
Sure.
That is yet to be seen, but certainly that's another interesting kind of wrinkle in this whole space. So data centers are going to continue to be a very significant, I think, part of the commercial real estate industry.
Yeah, I mean, I don't think our eyes are going to come off of that topic for a very long time.
Very true. Very true. Elliot, I have another discussion topic that I wanted to sort of pick your brain a little bit about. There was some headline that I saw earlier this week about the government sell-off of these properties across the country. We've talked about this as well, but interestingly, the headline was basically saying something along the lines of, this is really going to wreak havoc on the commercial real estate industry. And I have a little bit of a perspective on this. This is my perspective, obviously.
Sure.
But I have a sense that this is going to be a big old nothing burger, to be perfectly honest. And here are my thoughts, and I'd love to hear what you think about this also. One, if these buildings are going to be empty, you and I know that value of any asset is based on this sort of revenue that this asset can generate over a certain amount of time, right? So its value is going to be calculated by some net present value of its future earnings, that kind of thing. If you are putting on the market a vacant property, I don't see how the value is going to be at all appealing to anybody. I mean, these buildings are not value based on the amount of bricks and mortar you put into them. They're based on cash flow. If the government was really thinking about this right, they probably should have just filled these buildings up, signed 10-year leases.
Right, long-term leases.
Yeah, right, exactly. With 10-year options, 5% renewal escalations, things like that, where you're going to give somebody cash flow. I think that would make it an interesting asset. And maybe that would potentially wreak havoc on the commercial real estate industry. Just trying to sell an empty building, I don't see how this is going to, entice anybody. What are your thoughts?
It's headline chasing, right? There's nothing havoc wreaking about this. There's myriad angles here to take into account. One of them is that ultimately the market does self-correct. And if you're looking at, these assets and their value, they're not going to be established comps that control the rest of the market, because it's not like single family where comps are really there's so much less of a delta. With commercial, I mean, everything from the year it was built to the occupancy. Single family is not an occupancy thing, right? It's occupied or it's not. There's no percentages. So I think its impact on comps is basically nothing. And frankly, as you and I have talked about, I just don't think these things are going to sell. So fundamentally, what we're going to have is empty buildings that were owned versus empty buildings that are still owned but trying to be sold. The difference between those two topics is nothing.
Right. And I think, I know some of them are, based in downtowns of certain markets. Like I know there's some like in downtown Seattle, downtown, Portland and so forth. Those may be interesting to certain folks, right?
Yeah.
But again, it's going to be based on, how vacant it is, right? If there's an opportunity for them to be filled out, if they're going to be laying people off as they have in the last few weeks.
Right.
I just don't see how this is going to wreak havoc. I also don't know if these buildings are technically even counted in the sort of inventory, if you will,
Right.
of
Right.
commercial buildings, because I guess they're not privately owned, so maybe they're not. And again, I just don't see how this is going to be a big issue. I think what we've seen with that one portfolio that you and I talked about in Olympia, Washington,
Yeah.
that's being on the market for now 2 or 3 years. If anything does happen, it'll probably just be on the market for a number of years until, I don't
Right.
know, they decide to reuse them or raise them or something like that. But I don't see this impacting the commercial real estate space.
There's only one thing that's been really on my mind about these assets, and I posed the question to a few clients. I posed the question to my team. I actually don't have an idea here. I'm kind of curious, and I'd love your thoughts. So again, translating commercial to residential just for the sake of the thought experiment. When you're selling, I'll actually use something that's already happened in the Palisades post fire. And some sort of burned out dirt sold for, I think, like $1.2 million or something. I was
Right.
hearing.
One of the parcels, yep.
And right. And, from a development perspective, that person is going to make a killing because they're not buying the house. The house is gone. They're buying the dirt. So I'm wondering with some of these buildings, now it's probably not possible with, the Nancy Pelosi building in your backyard and some of these other buildings. Could we be looking at valuations based on residential redevelopment as opposed to a valuation based on a vacant office building with almost no hope of lease up, which will get you exactly what we're talking about in Olympia? Nothing but,
Yeah.
a sign on the door that never goes away for sale. But some of these older ones, are their floor plates able to be converted? At which point could we see opportunistic investors say, I'm buying the dirt, so to speak. I'm buying the building. I'm not buying the office building. I'm buying the building. And my plan is to renovate it to an asset class that actually has, seemingly insatiable demand.
Yeah, I think the big issue there, anecdotally from what I heard, is again going to be the cost. So what are you
Right.
buying? On the development side, per door, developers, at least on the West Coast, are looking at $600,000-700,000 per door, right? So you're gonna need to not just buy it, but you have to buy it so low that it doesn't impact that per door price, where it's
Right.
so unreachable that it just doesn't make any sense. Then on the flip side is, what can you get in terms of rent, right? Rent growth has been kind of anemic over the last couple of years.
Yeah.
I think in certain markets we've definitely kind of hit a bit of a ceiling. What developers can charge. So look, yeah, maybe anything's possible. I think it's just a matter of finding that right asset and that right mix of cost versus debt versus construction, right? How all that's going to play into you actually delivering it.
Well, an idea for the Trump administration, and perhaps they should hire me.
I,
What
I
would be
don't
an
I don't
incredible,
think this is going to be on top of their list of things to do this week, Elliot. Call
definitely
me
not,
crazy.
but what would be an incredible PR/political maneuver, as well as I would argue a financial maneuver, is to take some of these buildings and since they own them and they are the government, can we offer incentives, tax breaks to any buyer that comes in and as part of the paper, as part of the transaction, there is a ironclad commitment to convert this to multifamily and we can do whatever percentage of below, AMI or whatever, like a percentage, Section 8. I mean, it's a hell of a PR stunt.
Yep.
And it probably makes financial business because then some of the administration's wealthier friends, the Sternlichts and the Grays of the world, they can come in and buy these things for pennies on the dollar, turn them into multifamily, and everyone gets a political win, everyone gets a business win. I mean, it's not that easy, obviously. Nothing is. But I think it's worth looking into. Can the government make it more attractive to get around some of those challenges that you're talking about, which we've been talking about as an industry for 3 or 4 years? Yeah, great. Let's convert all the office buildings to apartments. Not so easy.
Yeah, I mean, I think the cynic in me sort of thinks that the priorities of this administration are just elsewhere. This is not about
Sure.
building housing at this point. It's sort of finding, cost cutting to pay for the, huge tax bill that's coming, or. So I think that those are all great ideas. I think some of these properties probably do have an opportunity to be remade into something that would be very usable. I also wonder what's going to happen with the next administration. If they go back
Of
and sort of
course.
realize, hey, listen, we're going to need all these people back, right? I don't know. This is going to be a lot of kind of back and forth. I think we really settle on,
Yeah.
the usage of some of these properties.
Yeah.
Yeah, it's a funny time. That's for sure.
And, housing remains, arguably the narrative. I think I've described it to a few people where it transcends real estate, obviously. It's
Right.
arguably the topic on the national discourse. And of course, it's, front and center for our industry. So, this week I kind of want to go inside our minds as opposed to just mine or yours, since I know we're both following this. And there was a couple of different things that came out this week from Redfin that I think are incredibly newsworthy and relevant. And I do have some bones to pick, which I kind of always do. That's my jam. But one was kind of a report on wealthy renters. So when I was growing up, it was very, very clear that people who could afford housing purchased and people who couldn't rent it, and it was really just that black and white. There was no sort of gray area. Now, obviously, that's changed for myriad reasons, but the report ostensibly was kind of putting a bit of a spotlight on the idea that plenty of people renting, in fact, they said nearly three-quarters of the most populous US metropolitan areas, have seen wealthy renters take up a bigger, sort of piece of the pie. And
Yeah.
these are people who could afford a house. It's not
Yep.
it's not merely economics. There's a lot more to it. I don't find this incredibly surprising. I don't know if you do.
Yeah. So anecdotally, I talked to a couple of executives over the last few weeks, of sort of home builders names you would definitely know, sort of West Coast national. Their perspective is that over the last couple of years, that the quality of the tenant is just remarkably improved. Meaning, the people that are applying for their units, apartments, townhomes, right, to rent, is just surpassing anything they've seen in the past, right? And so this again, I think anecdotally shows. Again, we're referencing a Redfin report that just came out this week about this, and anecdotally, I can attest that this is true. Now, you and I were talking about this a little bit, about trying to figure out, what is the cause of this, and I think it's sort of difficult to pinpoint just one thing. It's never one thing, right?
Right, right.
One of the things that also could be impacting this is you have a single younger demographic that's becoming more wealthy, that
Yep.
is working in tech or industries that generates decent amount of money, and they are just wanting to live closer back to the office. I mean, there's definitely a push sort of return to office, or I think you're seeing people that
Sure.
maybe lived far away or in rural areas are now kind of returning back, right? They've saved a lot of money. I think the general economic picture is probably pushing some people away from buying right now. There's been some stories during COVID about buyer's remorse when people are buying homes,
Yep.
and I do wonder if that's sort of playing a role into sort of the human psyche. Is this a right time to buy? You and I sit on the other side of this. You and I sit on, if you can afford it, buy it side, because
Right, right.
generally I think you are going to create wealth, especially if you're going to sit somewhere for 7, 10 years or something like that, right? You're
Right.
you're going to do fine. But obviously, not a lot of people feel that way, right?
I mean, including their chief economist. At
Yeah,
Redfin, that is, and
right.
that's kind of my bone to pick with them. Sort of come at me, bro. But they said, and I quote: "With mortgage rates near 7%, renting frees up cash for other investments that may be more lucrative than real estate." End quote. What investments are they talking about? Because over a
Yeah.
long enough timeline, residential real estate is, I mean, I don't want to be bombastic and say the safest, but certainly in that first tier, if you buy anywhere near a relevant gateway city, secondary city, tertiary city, and you sit on that for 10 years, you're going to
Especially
be up double
where
digits.
supply is not getting increased at all, right? And we've talked about this, right? There's just no
Right. Yeah,
building
I
it
mean,
around some of these bigger markets, right?
yeah, you're up high double digits usually.
Yeah.
And I just don't understand that sort of idea. Because if I took, let's say my mortgage, which by the way, renting, because I was able to refinance when rates were really low, renting would arguably more expensive monthly for me. But if I was to take any of that money and let's say put it in the stock market, I would be very surprised if my return over 10 years would be equal to my theoretical equity on owning a home. I mean, since sort of the dawn of modern time, the notion of owning a home as a generational wealth builder is just accepted.
Yeah.
No one's ever argued against it.
Right. Agreed. Agreed. And what's interesting about that also is, what are these alternatives? I mean, the stock market. I mean, okay, maybe you can be
Right.
lucky and get into some, good shares or stocks or something. But I don't. I mean, that's kind of gambling. There's no certainty there,
Right.
and of course, there's no certainty with real estate either. I mean, but generally, over a longer period of time, you are going to see, I think, returns, probably better than the stock market. I also wonder if, I mean, you talked about you refinancing, but not that long ago, maybe 3 years ago, even, we were still talking about rates in the 3 to 4%. And
Right.
I wonder if just the collective memory is that, hey, listen, maybe I just need to hold on a little bit longer. Let's see, maybe
Right.
they'll be back to 4. The Fed seems to be, reducing their rates here. Let's see how things go. That kind of thing. I think there was probably some enthusiasm around, the new administration and hoping that we would kind of go in the right direction. Not sure that's happening in the
No.
next sort of foreseeable future, but yeah, I am with you that this is generally a good investment, and if you can afford it, you should get into it. And related to this is another Redfin sort of report that you and I talked about that came sort of this week as well, which basically highlighted how the wealthiest 1% in the country could buy
Right.
out the homes of the remaining 99% of this country. And I think this is probably, a number or a ratio or a, relationship that never existed to this extent.
For sure.
And it's showing how, this is going to be a huge issue, I think, in our economy, in our society. I think it's a highlight of true inequality that I think somehow needs to be managed. I don't have all the solutions, but I think starting with building more, I would start with that for sure,
Yeah.
because I think this wealth gap typically does not lead to good things. And I come from a country where I've seen this happen a few times. And I do sort of wonder, what this means for, the United States in the future as well. What are your thoughts on that?
It's only going to get worse, frankly. I'm a pessimist on this topic. I think that from a statistical percentage, because eventually something has to be statistically 0%, even though, of course, it can never be zero, a true zero. I think we'll get to statistically zero. I mean, in the coming years, before I retire, as it relates to sort of the amount of people that are on the complete flip side of what you're talking about, that sort of 1% that can purchase the 99%. And I think a lot of it is also going to come down to, again, going back to poking at that Redfin thing, median home prices, I mean, you just have to look. I mean, we have the receipts. None of this is actually a mystery. That's the beautiful thing about looking backwards. Median home prices are up 45% over the last 5 years. We're not talking about a drop in the bucket here.
Yep.
45%. And still, and yet, despite that massive uptick, the stat you're referencing exists.
Yep. Yeah,
And,
exactly.
we're only going to see additional wealth creation for certain cohort of society. And it's always that way. I'm not necessarily one to immediately minimize that. It's just sort of the way things go. And then the last thing I did want to add about the housing situation is the construction thing that you're saying we need to build more, right? I mean, the supply is a major issue. Going back to what you were talking about the interest rates, which, by the way, is kind of a hysterical topic to me because the amount of times it's been below 4% in the more than 4 decades I've been on the earth is like measured in months, not years.
Right.
So this idea that it's going to get below 4%, like, guys, don't be prisoner of the moment. It's not coming. Not because times are bad, but because that was the exception to the rule, that I was able to refinance sub 3. I didn't need the equity. I just saw sub 3 and said, well, hell. But going back to what we're talking about here, you're going to see continued cash buyers and investors pick up homes. And that's going to lead to the wealth creation that you're talking about here in terms of that disconnect and that widening gap. Is as more and more of these people who already own homes invest in additional homes, they will be building the multi-generational wealth, while not the wealthy renters we just talked about, but the more economically induced, if you will, renters don't get to build that generational wealth.
Right. I agree.
A handful of them will start some massive successful company or invest in the next Amazon, et cetera, et cetera. But that's on the margins, right? We can't bank on that.
Yeah, I agree. That's like looking at the guy in the casino that just won the jackpot, and you think you can do it too because you're in the same casino where he is, and it's that ain't happening, right? So it's slow and steady, and I think it starts. With sort of jumping into that market and trying as much as you can to at least get into something, right? But that's a whole other set of challenges, right? Including trying to get people out of their homes, right? Which is not an easy feat these days.
Oh yeah. I'm never selling this place. It's just, I mean, it's my theoretical grandkids' wealth creation tool, right?
Did you know another report that I just saw? Did you know that an average, and I think this has increased, but in the last, I don't know how many sort of years, but the average sort of homeowner is now in the house over 10 years. And in California, the number is 20. So it goes again, another one of these hurdles that makes it harder to kind of get into a property, right? But that longevity inside the same property, definitely makes it harder, right? So you are seeing wealth creation, but at the same time, you're seeing probably folks like you and me that even if we try to sell, where do we go?
Right, the upgrade thing, right?
Yes.
It's an ongoing kind of, I don't want to say not talked about enough because certainly both you and I are privileged people. We own homes. But yeah, I mean, typically the starter home is supposed to be a, I don't know, 10, maybe even 5, 12-year thing.
Right.
I mean, I got neighbors across the street who bought their starter home 25 years ago. And just based on upgrade costs for me to go to sort of the next phase, and I'll use me, I'm a relatively young person. I have a young child. I'm sort of the target demographic here.
Yeah.
The next step up isn't a few $100,000. It's massive.
It's double. So, it's probably double,
right?
Right.
Yeah, it's double. So even though this house is a wonderful wealth creation tool, the chair I'm sitting in, even with all that, the equity I could pull out of it today, which would be lovely, is not enough to take the next
Yep.
step. It's
Yep.
just not.
Yep. Yep. Well, those are some
It's
things
an
to
ongoing
consider.
topic.
Ongoing topic.
Yeah.
Yep.
Housing, we're going to be on this, I think, every week. Housing, office, and I think this data center thing, it's going to be the gift that keeps on giving.
Yep.
Well, let's get to our interview. So we will hear from Bayport Funding CEO Marcia Kaufman. She actually touches on some of these things, interest rates, and does share kind of my comedic reaction to people thinking that they need it to be 3.5%, 4% to purchase a home. But with that, Vlad, always a pleasure.
Same here. We'll see you next
Talk
week.
soon. Marcia, hello. Thank you so much for taking time to talk with us about all this stuff.
Elliot, thank you so much for having me. I'm very excited about today's podcast.
So, why don't you tell the audience a little bit about you and the company and what your guys' focus is?
Okay. So I've been in lending for over 30 years. I started on the residential side, mortgage banking, really enjoyed it. It was a thrill of having homeowners have the American dream of obtaining a home, which is really the American dream. And after a long time of doing that, post the mortgage meltdown crisis, I parlayed my skill set into acquiring properties in the three boroughs of New York, Brooklyn, Bronx, and Queens, and started to acquire homes, renovated them, and then resold them, hence fix and flip. Very
Yep.
different than being a lender, but I really have a feel for the real estate asset in particular. I understood the values. I understood how to do the renovation. I had my crews, I had my teams, and I bought about 50 homes and I fixed and flipped them in the three boroughs of New York City. I dealt with building departments, a lot of hurdles that you have to build. It's not what you see when you watch HGTV and it says fix and flip. If
Yeah.
that's not even close to the reality, that's not reality TV. I was living
Right.
reality TV. But my real passion has always been lending. 30 years, I was a residential, I call it a resi girl, lending on the residential side. I had my own mortgage banking company, and I wanted to get back into lending. And then Freddie Mac, at that point, home ownership was down, and Freddie Mac was offering a license to commercial lenders for what was called single family rentals. And what the
Mhm.
single family rental market was, homeowners were not looking so much to buy at that time, but they were looking to rent houses instead of apartments. Why rent a 2 bedroom or 3 bedroom apartment when you can rent a 2 or 3 bedroom house, have a backyard, maybe a pool, maybe a driveway, bring your family, and it became a phenomenon. Not only did big institutions enter the market and buy tens of thousands of these homes across America, it became an asset class that institutional lenders, commercial lenders said, let me finance. So I took the opportunity. I was offered the opportunity to come back into the lending, but on the commercial, on what we call commercial lending, because you're lending to an LLC. And I
Right.
came back and came to this commercial lending, which starts as somebody looking to acquire a 1 to 4 family home. They're either going to fix and flip it, or they're going to use it to keep it as a rental property. And then that parlayed into those borrowers as they became responsive, more experienced. They said, I just don't want to buy a fourplex or a 4 family home. I want to buy a multifamily home. I want to keep it. I'll buy 8 units or I'll develop 8 units. I'll develop 20 units. And with that, our company grew to support those very seasoned sponsors or developers. So at Bayport Funding, what we do today is we do bridge financing, ground up construction, fix and flip rehab for real estate borrowers, developers, sponsors that go in and want to add value to real estate and need short-term debt to prove their theory.
So when you started working in, I guess it's not really vogue to call it SFR anymore. Did you have any
Uh,
uh, idea it would become the BTR behemoth that it kind of is now?
Actually, I did because I understood the housing need across the United States. And yes, I also understood there was a change in the mentality at that point in time, pre-COVID, of what people wanted to own versus rent. COVID was a game changer. Okay. But millennials and younger, they didn't want to commit to necessarily a 30-year mortgage or put roots down in a certain community. They wanted to have the ability to be more transient, and going to a BTR, built to rent community, or a single family rental gave them that flexibility until hopefully maybe they mature enough or they have a family and they want to put down roots in the community. It's still a very desirable way to be in a rental community.
Yeah, that makes sense. So, on the point of lending, I want to jump right into that. That's obviously where you're at. That last 18 months, maybe longer, depends on how you kind of gauge this stuff, that the market's been struggling. Cost of capital has been just a massive challenge and something I hear from developers in every asset class, right? Debt's not cheap. It's really tough to get. Being an alternative lender, I know I'm painting all of this as negative, but that's where you come in, right? That's your time to shine, so to
Sure.
speak. So how has that been for you? How is this part of the cycle?
So, with I think as the Fed started to increase interest rates and some of the banks had some liquidity problems, many local community banks had pencils down on lending, or rates were so high that it didn't pencil for a developer to do a deal. But what you saw is many more. Bayport Funding's been around for 10 years. We're not new to this industry. But what we did see is we saw a lot of institutional companies come in, firms, Wall Street companies, funds, hedge funds come in and offer alternative lending. One, they like the yields, right?
Right.
So that's very important. But it was very necessary because it helps support the real estate development community. And interestingly enough, where bridge lenders are usually a higher interest rate cost to the developer, with higher interest rates set by the Fed increase, it's not that wide a spread. And we're also short-term debt with long-term debt. So alternative lenders really bridge the gap for real estate developers to be able to find opportunity. In every market, there is opportunity. It gave a developer an chance to come in, find opportunity, and know that there's an alternative lender that will be there to support them from a borrowing perspective.
Now, do you expect that same sort of part of the cycle, if you will, to subsist through this year? I mean, what's your forecast look like?
So I do see continued opportunity. We could talk about the multifamily sector a little bit. Everybody knows there's been some distress on the multifamily only due
Right.
to the rise in interest rates. Multifamily owners who bought properties or refinanced property when rates were, 3%, they're usually term loans. They're either 3, 5, 7, or 10-year terms. Those loans are coming to maturity and they need to refinance. Although rents have gone up over that period of time, interest rates have gone up also, along with other carrying costs or maintenance costs, insurance costs, and some of those deals don't pencil necessarily to a refinance. Also, many of those multifamily owners over time took their equity out, so their loan balance today is higher than their loan balance when they took out that initial 3% interest rate, which is what a multifamily owner will commonly do is they will buy the property, they'll get their rents up, they'll take their equity, some of their money off the table tax free, and they have a higher loan balance. Well, the challenge that we have in today's interest rate environment, where it doesn't pencil for the refinance, what do they do when that loan matures? They have a
Right.
couple options. They can add some of that equity back in. They have it, right?
If they have the liquidity,
If they
right.
have liquidity, or they can try to sell at a lower price, maybe closer to what their loan balance is, and start all over again. So they
Yep.
do have options. Or depending on the lender, they may say, "Listen, I've extended you. It's time for you to give me back the keys or go to foreclosure." So we're going to
Right.
see a lot of movement. But in all that movement, like every cycle, it breeds opportunity for new people to come in or a new borrower to come in and take over an asset or to do something with that new basis of that property where it's going to trade. So I see opportunity. Somebody's distress is somebody else's success,
Right.
right? Um, and if a deal pencils today, when a lender takes a look at a deal today at a multifamily or an SFR, whatever deal that we're looking at, depending on which asset class, if the debt service coverage ratio pencils today, based on today's interest rate environment, today's rents, and today's expenses, right, and the right leverage then it makes sense because then you can do that deal. Then the deal, a lender will do the deal. Especially a bridge lender like Bayport, what we'll do when we underwrite a deal, whether it's a ground up construction or someone's acquiring a building to add value and stabilize it until they get a permanent loan, we'll take a look and we'll underwrite those loans to an agency takeout, Fannie or Freddie. Why? Because the agencies will always be here. The borrower can go wherever they want, but we want to know they can get a loan at the end of the day. 2 or 3 years ago, when those borrowers came to us, we didn't underwrite those loans to a 4% rate. We added 200, 250 basis points because by the time they finished their project, we didn't know where rates would go. Everybody thought it was artificially low. And we were very fortunate, and our portfolio proved that we have a very good performing portfolio. We didn't win. We lost a lot of deals. Why? Because we lowered our leverage and we had different criteria. But at the end of the day, the borrowers that we were able to capture, we actually protected them from bad decision making because we said, listen, you don't know what the future brings. And now they have a way to exit their bridge loan to their permanent loan.
Yeah, that makes sense. So in multifamily, sticking there, kind of the two biggest topics I've been reading about for, I mean, well over a year at this point. One of them is, of course, the doomsday talk about wall of maturities that I have said I think is a little overblown, but maybe a lot overblown, but that's up for opinion. But the other one is redemptions. And especially on the institutional side, where, when you invest with, I don't know, let's use Graystar, not because I'm picking on them, but because they're number one. Why
Mm-hmm.
not? When you invest with Graystar as someone, I mean, you're expecting return, right? I mean, these guys are number one. They're the big dogs. So, as all of these players, Blackstone famously in the last year has shut down redemptions, and typically investing with Blackstone, I mean that's buying Apple stock, right? I mean, like everything's going to be okay. Um, how have you managed in terms of your capital sources and dealing with redemptions? Whether you've had to pause, halt completely, how has that been on your side?
So, Bayport's capital is comprised of a couple, different sources, but we do have two funds. So let me talk about that. We have two funds that we run. So during COVID, which was crazy, the minute COVID hit, like what was it, March, and the first payment cycle was April 1. Now
Yeah,
Bayport and other alternative lenders, we lend to non-income producing properties. The borrowers have to get them income producing properties. First, they have to either build them, stabilize them, rent them out. So when we analyze a borrower, we take a look at their liquidity to make sure they can carry those properties during the period of that bridge financing loan, right? The shocking thing is we were in 30 days in, everybody's calling, I have no money. Well, a month ago you had a ton of money, today you have no money. People got scared.
right.
So for a company like us, we have a personal guarantee on our loans. So once we also said, listen, you have money, you're just nervous with the environment, all right, and we have a personal guarantee. Performance was at 96%. To the fund side of that, to answer your question, the fund people were also very nervous. I don't know what's going to be. I might need my money. I might need this. Are you going to be able to pay? Once they saw that we pay on the 10th of every month, once they saw on the 10th of the month their money was sent to them, their payment was sent to them, we have a different type of fund, they all relaxed and they saw our performance through COVID. We actually had more people put money into our fund. It was phenomenal. That's based on performance. So we have a different type of fund that we run here. And we've been very fortunate because we are also short-term debt. So if somebody's participating in a deal, that deal is usually done 12, 24 month, on a rare occasion, 36 months. There's a short window or a light at the end of the tunnel that they see it pretty quickly. We haven't experienced that run on redemptions. We've had a couple people for their own personal needs, and we don't have a problem if they need a redemption. They give us a letter. It's earlier than they should because we just don't, we work very well with our clients. Regarding the big funds like the Gray Stars and all those, when you put money into those type of funds and you read their prospectus, it's loud and clear. You can't just be in for the win, right?
Yeah,
If you fill out and you qualify to be in that fund, you're sophisticated enough to know that you're in it for the up and the down. You like it when it's up. And when it's down, you don't like it. Also, real estate is not a short-term investment. It's a long-term investment strategy. So you have to be very patient to see what happens with that. It's like the stock market. When the stock market drops like a rock, it's not the time you take your money out. If you make good investments in good, healthy companies, right, and you believe in there, and that you're just not, I don't want to say knock a day trader, but you're there made the right, and then you need to be patient, and hopefully it will work out. Sometimes it does, sometimes it doesn't. The good part about real estate is that no matter what, even if a property doesn't happen the way it was planned to happen, that asset doesn't go away. You don't lose 100 cents on your dollar,
Right.
right? That's why I like real estate. It's never going to go away. So
Right.
you're going to get a return on your money. You may lose a little less, maybe you'll make a little more, but you're never going to end up with a zero for the most part.
So talk to me a little bit about like borrower profile, right? So coming from maybe the fix and flip, right? You started with probably just, John and Jane Q Public for lack of a better terminology, or smaller investors. How has that progressed? And then perhaps most interestingly, and you can correct me if I'm wrong, how have the last few years specifically been in terms of like your borrower profiles kind of evolution?
So our loans always start with the sponsor, the borrower, and who that person is, and then it's the property or the asset they're buying, right? So Bayport always looks at, are they in the industry? As I said before, we hope they're not sitting at home watching HGTV and they decide to be a fix and flipper. They have no experience. They're a local, whatever other industry they're in. That's not our borrower. We're not interested. We want somebody in real estate who has the experience and also understands what it is, has their crews lined up, their construction crews, has their team who's going to sell their property. Do they have their attorneys? If you're an attorney state, title companies, do you have your team put together? So, and then if they're, and we don't really lend to a first time, we want to see somebody with some experience. And I'm going to work my way up the stack. And then, we want to see what their liquidity, because a project can take a little longer, or a project might have some unknown things when you open up those walls. You just
Right.
don't know. As much as the lender might do an appraisal, or the borrower should do their market research, we ask them that question. What are the trades going? We want to see that they brought their comps. We want to see they did their due diligence. But sometimes the market changes. And by the way, the house you think that you can make the most money on, and the house you think you make the least money, the house you make the least money sometimes sells the fastest, and the one you think is the home run you're sitting with for the longest period of time. You just never know. But so we start with the borrower, who they are, what their track record, what their experience, and they may start to fix and flip, and then they may decide to take a duplex and turn it into a 4-unit condominium, right? And they work their way up to a ground up development. They'll do an 8-unit or a 6-unit, 8-unit, and then all of a sudden they take on a bigger project. So the sponsor who's doing the multifamily is usually a much more experienced, much more sophisticated sponsor. Also, the leverage point is usually lower, ironically, than the fix and flipper, right? Because you have to leverage to the takeout. You have to meet those. You have to meet those criteria from debt yield perspective, DSCR perspective. So it's a completely different underwrite. So, that sponsor, we look at the same way. What's your experience? What's your track record? And it's very important that you actually verify all this information. What's their
Sure.
personal financial statement? We don't look at their tax returns because most real estate investors are self-employed. That's not going to show me much, right?
Yeah. Yeah.
Not going to show. But their PFS, their liquidity, their track record, their credit, their LexisNexis, those are very important criteria. And then we look at the property. Okay, so that's how we really dissect it. When all the big institutions came into the to support the fix and flip business, we saw a barrage of them come in. I would say 2018, 2019, 2020, and then COVID hit. They came in and it was a race to the bottom from an interest rate perspective. They gave it
Right.
credit quality. They thought it was a big party because real estate was appreciating at such a rapid rate that any mistakes you made as a lender was buried in appreciating real estate. And then
Right.
COVID hit, and all the mistakes rose to the top. So we had all these institutions that came in to compete with more private lenders like a Bayport Funding, and some of those lenders are not here today. And what we also saw was a lot of what we call super brokers come in, where they would close a table fund, their loan, and they would assign it to another lender, but they didn't really have an experience. They were really just a broker, just assigning it. They had no risk. You know, a true lender, a true alternative lender, we hold these loans on our balance sheet, and that's a very important criteria for a majority of reasons. You know, those are some of the things that we take a look at when we're underwriting the client, and we also look at the environment of who we compete against.
And has that profile changed at all since COVID? Has the profile been affected by that obviously seismic event in terms of world, let alone real estate?
So, you know, it depends on which lender you're talking to. Because I myself have deep experience in mortgage lending, as do some of the principals, and my staff here is all very seasoned staff that are from the industry. The hardest thing to do is to not give up credit quality for quantity. When you're
Right.
facing competition in the market and there's a lot of liquidity in the market fighting for deals, there are far fewer deals or transactions. Supply is very tight. So when you have to return a yield to your investors, a return to your investors, you need to bring it to deploy that money, correct?
Yep.
So then you start to take a look at doing maybe transactions that maybe you would not have done. Bayport has a very strong philosophy. It's been very difficult, but it's proved to work for us. Is that we don't give up credit quality for quantity, and when you do that, whatever bottom line you draw and whatever returns you give to your investor, you're going to take it away next year because those loans aren't going to perform. You're going to give it back
Right.
in ten. I won't say tenfold, but by multiple. It's a very hard discipline, and like most CEOs, you know, I report to people. I report to ownership. I report to a board, and it's a struggle that they have because they want volume, volume, volume. And I'm like, we're going to have good volume and performing volume, and we're not going to give up quality for volume. And it's been a very hard line for me to draw with them, but they really appreciate it at the end of the day because our business is great. It's really great.
So I want to return to something we touched on a little bit earlier, and I made my opinion very clear on Doomsday. How does the wall of maturities impact your business? You know, how are borrowers managing refinancing? And how big or not big of a deal do you see it as?
Listen, it's a challenge. Everybody thought that, you know, the Fed started to lower rates in 24. And now we have a pause because we're struggling fighting inflation. We're not there yet. That 10-year bond is holding on like no other. I think it came down a little bit today. It's a struggle because everybody's been waiting for a little easing in the interest rates so that they'll see some relief. It's a challenging market, no doubt. I'm not doomsday, but it's definitely a challenging market. From a bridge lender perspective, what I see is at other colleagues in the industry, other lenders in the industry, we all have maturities on our loans as well. We can only hold the loan so long on our book. So Bayport will refinance a bridge loan if it has a maturity issue but not a performance issue. It's a very big difference. Okay, because you have loans that are performance, and you know where we are happy to help them if they're mid construction, they just need a little more runway, and it proves out that the leverage makes sense and the exit makes sense, and we will support those borrowers for maturity event. And we see a lot of that going back and forth right now. But you also have a lot of borrowers that it's not a maturity issue; they just not paying. You know, they're not paying. Um,
Right.
you know that's part of being a lender. You can't be a lender and not have people that you know what percentage is acceptable is really what you look at as an industry. But that's the short term. That's the short term, you know, financing. The permanent financing or term financing for the either the multifamily or is difficult because rates haven't come down. And if they didn't underwrite those deals based on an interest rate, let's say with a six handle, let's say around a six handle, it's a challenge because they'll have to, add more equity cash into their deal. On a single family rental, or not single family rental, or both single family rental and the fix and flip, when you're buying a single family house to renovate that you want to keep, and the interest rates are for the permanent loan when it comes off your bridge are in the 6.5 to 7.5,
Right.
does it make, are the rents covering at the loan amount that you have? And if you're going to fix and flip and the end user is a consumer, there are less consumers that can qualify at called 6.5 or 6 than they could at 3. So it affects every area of the business. I am optimistic. I think there's always. I started, to really date myself. I started when rates were 18%, you know, and not it didn't stay there for long. It came down to 13, and then it came down to 9. That's the real estate market. It's a cycle. It's a cycle. There's opportunity and there's sometimes pain. You don't have one without the other. I rather have right now. I think I'd rather have that type of cycle than a boom cycle because a boom always goes to a bust.
Right. Right. You go too high, too fast. We know what happens.
Correct.
So I want to close on the topic of interest rates, which you've mentioned a couple of times, and one of the big sort of fights that I see maturing here is we have interest rates that people, to your point, were hoping would come down significantly, and it looks like no. Um, on the multifamily side, you have rent growth being basically stalled for going on 2 years. And I've read and I've heard from people that went to NMHC, we'll see a little bit of rent growth this year, but it's not going to be earth shattering, right? I mean, it's going to be nominal, is my understanding. And you're totally welcome to say you have a different viewpoint here. So, how does this affect multifamily investors? Because you're looking at value add, right? I want to add value to an apartment. I mean, this is the oldest part of the multifamily investment industry.
Mhm.
You buy, you put lipstick on the pig, you push the rent. This is Yahtzee. I mean, it's not a complicated business. Um, well, when you can't push the rent, things get really complicated. So, how are interest rates affecting that?
So, that perspective on a multifamily buyer is, in my opinion, is a mistake. Why? First, we're in a normal. I think we're more in a normal rental environment. So, if you're buying for a really rapidly increasing rent environment as your model, that's risky. Multifamily, to buy a multifamily property is for generational wealth. It's not to buy, get your rent up as quickly as possible, take your equity off the table plus, and then you're sitting there and you think you're worth X instead of Y, right? It's to buy a good property, put lipstick on the pig, hopefully a little better, rent it out at today's rents, put in the normal rent increases that should be in a normalized market, not a rapidly rent rising market. And if you get a push in one of those markets, it's a winner. But underwrite your deal when you're looking at it as a borrower. You take a look to buy a deal as a buyer. Take a look at it as a normalized rent environment, not a rapid rent environment, because you always, that would be the proper way to look at it. Make sure your expenses are realistic. Don't tell me you have a buddy in the insurance business and he's got a deal because you're going to make a mistake. Don't say you're not in a flood zone when you are in a flood zone. Underwrite your property the right way, and know you're going to and don't when you get the rent up, don't strip your equity at it. Leave your equity in there. Build generational wealth for your family or for whatever it is. Hold the property 10, 15, 20 years. If you think you're going to hold the property 2 and 3 years and make a home run, you're going to you might get caught in the wrong market, which you're seeing what happened to people right now.
Right.
So all these people
Right.
got why? Because the 2 and 3%, everybody's a rock star on interest rates. Is 2. Everybody's so smart. Anyone can write a loan. Anyone can buy property. Rents are rising. Rates are low. Everybody was Einstein. No, this is a business. You need to approach it, in my opinion, conservatively. And by the way, you're not at fault as a multifamily home buyer if your lender didn't keep that in check when they lent you the money. So you weren't completely at fault because when the lender wrote you a loan at 3% because we were COVID, they had a lot of stimulus money, they lowered interest rates, and they didn't think as an experienced lender that it's an artificially low environment, right? What happens when your term is up? Then they're a partner in your mistake.
Right. They should have been the voice of reason that, this is not real. It's not this way. I think I was doing some research for a survey that I helped a multifamily owner with, and I think the rates have been below 3% one time in my life, and that was, a couple of years back.
Yeah.
So the idea that we need 3% is, where are you people seeing this? This isn't normal.
I think we're in a normalized market. Do I think the rates are a little wide right now? Maybe. Yes, but as I said, you heard where our starting rates. But if you
Right.
think that you can get a rate of 6.5%, I mean, it's a great rate. I mean, 5.5 is much better, obviously. I mean, but
Sure.
it's a more normalized, stable market. And I just want to reiterate, at what I said before. You know, our lending philosophy is this: we have borrowers come in and say, well, if you don't give me this leverage and this whatever, we're going to go someplace else. And they're good borrowers. And we're saying the deal doesn't make sense to lend you. You're going to have a problem exiting. You can't get a permanent loan. And at the end of the day, we lost borrowers, right? And they come back to us and they say to us, we should have listened to you. They found somebody else. You can always find somebody else you can always find a doctor that will tell you what you want to hear, right?
Right.
You
Right.
can find a lender, you can find a lender because everybody wants to make money. They're making deals, they're deal junkies. You can't be deal, you have to have what's in the best interest of your client and what's in the best interest of you as a lender. They're really very much aligned. They may not see it, but it is aligned.
No, I know I said we'd close on interest rates, but I have this terrible habit of saying
Go ahead.
last thing like 12 times. Um, I think it was Burroughs. When you stop growing, you start dying. So you mentioned 10 years. So as we enter decade two of Bayport, what's on the horizon? What's next?
Well, actually, we're so excited about this. Bayport started out as a lender for fix and flippers, basically in Brooklyn, New York. It was our hometown. We understood the assets, the neighborhoods. We could tell you every street, attached house, brick house, that house. And as our sponsors grew, we grew with them. And then we did, we did 6 units, 8 units, and we parlayed into multifamily. And we were really a tri-state area. So for going forward, what our growth plan is, one is we're really committed to middle market multifamily. I see the biggest opportunity there for a couple of reasons. One, the really large players, they don't want to do loans that are between $5 to $15 million. They want to do the 25 to 100 million. So there is a very underserved market for real estate investors, developers, or borrowers that really are looking for that smaller middle market multifamily, and we want to be there to support them, and that's a big opportunity. We're currently an East Coast lender, and we are going to be expanding on a national platform end of Q2 2025. So we're very, very excited about that. So that's part of our major growth plan for 2025. And forward is really growing our multifamily platform, increasing the size loans that we put on our balance sheet, and growing on a national level.
That's the right growth plan.
Very excited.
Uh, yeah, that makes sense. Well, Marcia, thanks so much for your time. It was great talking to you, and I have a feeling we'll talk again soon.
Thanks, Elliot. Have a great day.
You too.